Welcome back to this Will I Have Enough video series. In this video, I'm going to be working out a spreadsheet that shows you how much money you need to put aside each year to be able to afford a house or an apartment 10 years from now. The main problem, as I see it with a lot of the online calculators that do this kind of work or software packages, is that they tend to say if you save up X thousand per year, you will have Y thousand in 10 years, and that's either going to be enough or not enough. In reality, if you invest your money in risky assets like equities, which at least you tend to do for a part of your portfolio, there'll be a range of outcomes. So instead of saying we'll for sure have 100,000 10 years from now, we'll rather say there's an X% likelihood that you'll have enough. And that in turn will help educate you on the kind of risk you can afford to take with the portfolio and how much money you need to put aside every year. We'll also be working future changes in the property prices into the model so that we can see the interplay between movements in the value of the property, the price of the property, and your savings. The work in this video is based on an earlier video series I did where I built a financial spreadsheet entirely from scratch. If you haven't done so already, it may be worth your while to go and check out that video series as the model here is based on it, basically. My name is Lars Kroyer. I'm a former hedge fund manager who has written a couple books about finance, and I'm now doing these videos as a hobby. I'm not a financial advisor, so before you do anything I say in this or in any other video, do your own work, take your own advice. But let's get back to the spreadsheet. So here we are back at the model, and like always, I want to start by just doing one minor thing. Someone pointed out to me it's a little confusing. This section is based on the start of the year because we're trying to figure out how the contribution will be impacted by the market. So I just wanted to make that bold. But let's go back and do a save as like before. And let's call this saving for a house. You can make an apartment or whatever you want to call it. Okay, so now we're back. So now we've got the model in a state where we basically can't screw it up. And so format, column, unhide. Let's say we want to do this from age 25 to 35. You can make it longer or shorter as you want. So you see 10-year horizon. I'm going to delete these cells because we no longer need them. Rather. So there you go. Now, let's instead of this being ref, let's make it the end of the period. So now what we want to do is I want to add a few, just ignore this ref for now, we'll come back to that. I want to add a few rows just because I want to write a few things. I want to say cost of house current right now, current, cost of house at purchase. So this is 10 years into the future. Let's say you need a mortgage, which most people will. And then you can figure out equity needed for house. Then let's figure out what your savings are at that point. And then let's just add one more row. And then what we want to do is figure out whether you have enough. But let's just come back to that. So let's just, I'm going to be my usual self and just copy down some numbers because it's easier than formatting them. So there you go. So let's say we now can say we have the state where we're contributing 10,000. We don't need the spending stuff anymore. Also going to make this fee stuff go away. It's important, obviously, you would still be paying fees here on your savings. Check out my other videos on how you put these numbers in. Don't buy active management products. Is an overall lesson of mine. Okay, so now that we have the current cost of the house, let's call it 500,000. You're contributing 10%, 10,000 a year. You're not growing that. Now let's figure out the property value. So let's take this column, just because it's got some nicely formatted numbers in there. And then let's call this property value. And then start year. Oh, that's not good. Start. Oh, yeah. Oh, God, I can't spell today, can I? Start of year, end of year. Okay, so we know the start of the year, the first year, it was 500,000. So how do we know what it was at the end of the first year? I want to show you two different ways of doing this. The first way is using something called beta. Now, that's basically a fancy term for saying how much does the property prices move with the equity prices. So let's just do that and say property. Let's delete these guys. Property. So, you can make these assumptions whatever you want, really, but if we start by saying, let's say the property markets have a beta of 0.2. What that means, beta versus equities. Now, what that basically means is that, let's make this a multiple. Yeah, so we say 0.2. So what we're saying is that property prices are impacted by the economy just like the equities are. So, but perhaps not as much as equities are. They're not quite as volatile as equities. So what this is saying is that property prices move 0.2 in the same direction as equities. It's a simplification. In reality, there's, it has to do with the correlation between the two assets and how tightly correlated they are. There's obviously also individual risk in properties. They don't move exactly like equities, and that there's some random variables in there we really should have. But just to keep it simple, this is actually not a bad approximation. This is basically saying equities go up by 10%, properties go up by 2%. In reality, we said it should really only be on the premium that you normally would use beta, but never mind that. In reality, this is saying equities is compounding at 4.5%. Properties does 0.2 times that. Maybe we take down a slightly punchy standard deviation assumption, although you can keep that if you want. So now what we know is that the end of the year is equal to the start of the year times 1 plus the change in the equities times the beta. So times the 0.2, and the 0.2 is going to be the same every year. So there you go. Then the following year, that's the start of the prior year, and then we copy down this formula. So now we just copy this down, and there you have it. So just as a double check, in this first year, equities went up by 12%, and the property value went up by a couple percent. Yeah, that looks about right? So now we know that this number, the 467,000 in this case, is the house value when we have to purchase it in 10 years. So that's what that is. Okay, and as if you follow these videos, the reason the numbers change all the time is because we are using this randomly generated returns for equities. So let's say you'd have 80% mortgage, so you do that times 80%. Some decimals we make go away. And then the equity needed for the house is then going to be that minus that. So you need, in this case, you have a house, it's worth 500,000 now. In 10 years, we're estimating it's going to be 564,000. You have a 80% mortgage, so that's 451,000. So you need 112,000. Now, I don't think you should ever be in a position where you use all your money for a down payment on a house. In fact, it's my view that the overwhelming majority of people are vastly overexposed to properties. I made a video highlighting this. Please check it out. Let's just say that the savings you're talking about here are specifically your house savings. Think of it as your house kitty. We could have a line in here where we say, fraction of your savings you use for equities, but perhaps just ignore that for now. So what do we have in savings at that point? Well, we have the end of year 125,000. So this is because we contributed 10,000 every year, which is the column you can see there. And we had, in this instance of the model, 50% allocation between the riskless asset and equities. Then we have these randomly generated equity returns, which are basically, we just changed the standard deviation to 20%, but compounding at 4.5% after inflation with a standard deviation of 20%. Check out my earlier videos if this is a bunch of gobbledygook to you. Now, what I want to do is I want to figure out, do we have enough, right? So in this instance, it looks obvious, right? We need 112,000. We have 115,000. We have enough. One of the things I really don't like about the online calculators in most instances is this would say, yes, you have enough. You're sort of done. And I would say, well, not really. Sometimes you have enough, other times you don't have enough. These are, very volatile equities. So let's do it as a percentage. So let's just move this up here, cut, paste, and then do savings as a ratio of equity needed for house. And let's make this a percentage. So this divided by this and percent. So now it's 106% in this instance. Shows we have enough. Great. Now, then what we should do is we are rerunning this model 1,000 times. Again, from the former videos, you can see we're doing a data table where we're rerunning the model with these assumptions, this contribution, this movement in the property prices, these assumptions on the minimal risk asset and equities, this house cost of the house current, and with this mortgage. Now, if we rerun this 1,000 times, let's just change this to percent, because it's again this number that we're rerunning. And let's do formula and recalculate. Right? So now it should work. So there you go. So this is much, much more instructive. This is instead of saying, you will for sure have enough, it says in the 50-50 case, you will have enough about, you'll have in the median scenario, you'll have 120% of the amount you need. But that's the median case. What we really care about is how often will you have enough? And so let's go down and change the number down here. So let's say cases where it's not above 0, but above 100%. Just instead of having that be that, let's make it 150%. So now we can see how often will you have enough above 100%, how much will you have 50% more than you need. So this is the answer. This, I actually think, is what you really need to be told by the online calculators. Instead of being told, oh, you'll have enough or you won't have enough, it says, well, what this is saying is, in the case that you allocate 50-50 equities and the minimal risk asset, you will probably have enough 9 times out of 10. These are not exact numbers, because keep in mind, all these models are only as good as the assumptions you put into them. And also we're ignoring tax, and very importantly, actually, I really think you should not have this be 0. What this is essentially saying is, first of all, saying you contribute 10,000 a year blindly. These are real terms, so it's not a terrible assumption, but it's not unreasonable to assume you can afford more and more as you get older. But the other thing is, you really should assume that there's volatility in your contributions. If you lose your job or bad things happen, you can contribute less than 10,000 a year. So there's some inherent risk in those numbers. But there's also a very good chance that the amount you can contribute is impacted by the market. Right? In great markets, times are great, you can probably contribute more. And if times are really shitty, you can probably contribute less. So I think it really should be incorporated in this model. Of course, again, I really want to emphasize, don't ever put all your money into real estate. I think generally people are hugely guilty of thinking that property, safe as houses is an expression in the UK, which I think is just a terrible saying, really. House prices can be very, very volatile, and they tend to go down in value just at the same time as the local economy is crap, which is typically the same time as you lost your job and your education is worth less, and generally life is terrible. So you create this huge correlation of all your assets. The other thing I want to point out is, I live in London. This is recorded in London. London's had a massive property boom over the last couple of decades, and there are massive stories of people that bought a house, and it was, essentially was the biggest success story of their careers. It's not always the case, but people in London therefore think that their good times will continue forever. If you look at data from the best data available in the U.S. property market since I want to say since the late 1920s, and it actually shows that residential property markets has on average not been a great investment. It's barely kept up with inflation. So, I don't think it's a terrible assumption that these numbers are right. You could, of course, just ignore it and say, this is my future value, the 500,000, just make that number here. But I don't. I think you want to capture that there's variability going forward in the housing market that's hard to predict. I want to do one more thing, and that's a little bit complicated, perhaps, but I want to also say, well, instead of having the beta versus equities be a 0.2, let's just assume that property prices go up by, say, an average, so not CAGR, let's use an average of 1% per year instead. It would be super simple to change this. Instead of end of the year, we simply say it's 1 plus. Instead of the beta, we just say get 1 plus this number. So, it's this number. And then we make this a constant, 9, and we copy that down. And now we've made the number a change 1% a year. You can see we change it to 2, and the number down here changes. So that's an alternative way of saying it. In reality, what you would have is there would be some correlation between the property markets and equity markets, where part of it is driven by the beta and but on top of that there would be a random variable where the property markets would also have its own volatility separate from the equity market volatility. I don't want to get into that because I think it's adding a level of complexity to this model that would make it unusable for most people. But again, I think that the overriding, I'm actually a bigger believer in this beta situation than in just growing by 1% a year, but let's just keep it like that for now. So what we've gotten here is a model that says you contribute 10,000 a year, you want to buy 10,000 a year for 10 years, you want to buy a house at 500,000 that goes up in value by 1% a year, and you allocate, say, 50-50 between the minimal risk asset and equities. Let's be a little positive. Say, oh, well, in that case, you can only afford it in about 80% of the cases. What can I do about that? Well, I can get more risky, but it doesn't really move the dial that hugely. Calculate it here. But you can say, well, I should probably contribute more. Now I contribute 15,000 a year, and then what you find is, sure enough, you're almost always certain of making having enough money. Keep in mind the reason that the median goes up is because you're in the median on the average case you would have plenty enough money, but also the greater risk would suggest that in the very bad cases you would not have enough. Right? So that kind of makes sense that the higher volatility makes the numbers the bad cases go down as you're moving into the higher risk assets. But the key point that I want to get across here is I don't want to have this that will you for sure have enough or not for sure have enough. Well, as soon as you're into risky assets, which most people would be, there's no such thing as for sure have enough. Even in the case here, frankly, there'll be a range. There's going to be a range of outcomes, which is what this data table captures, which I think is really, really important. In this case, you see, would you, if you contribute 15,000, you don't grow it, can you afford 80% of a mortgage? Well, what you find is that even in this case, we did the growth scenario, but if you did the beta scenario, even if you had 100% in the low risk asset, there would actually be variability of outcomes, which makes sense because even if you put your investments in the low risk asset and that has no risk, the value of the house could still change into the future, which would impact how often you could afford to buy the house or not. So I hope this has been useful and interesting. And again, it's meant to be very adaptable. It's meant to be so that you can understand how all the numbers fit together and recreate this model in your own time and with your own assumptions. These are just base assumptions. I think they're pretty reasonable. The assumptions involve some I think shortcomings, perhaps you can say, that I discuss in other videos. But overall, I think this is going to be far better and far easier for you to understand than numbers that you put into an online calculator or a software package where you don't really understand how it all fits together. And also, I think those packages are guilty of giving a false sense of security from saying you will have enough or you won't have enough instead of explaining you this range. Lastly, it's also super important to understand the variability of contributions is likely to be a very real thing. But I'll leave it here and pick it up in a future video. So thanks for watching. I hope that was interesting and useful. You can subscribe to my channel if you want to hear future videos, or share this video with your friends on social media if you think they would benefit from watching it. But in any case, I hope to see you back on the channel at some point in the future.